Welcome to WCS Money Tutorials. Today's topic is modern monetary theory. Can printing money pay for government without taxation? Can government benefits be increased without raising taxes? This discussion focuses on the United States, though the basic principles apply to any financial system in any country. Modern monetary theory, otherwise known as MMT, is a set of economic principles and policy objectives designed to improve people's standard of living, emphasizing a greater use of fiscal policy and a more liberal use of monetary policy to achieve government objectives, such as helping the poor. Government objectives are more important than fiscal objectives, such as keeping the federal debt below a certain limit. Even though most money is created electronically, many people simply refer to it as printing money. Electronic money is created by the Federal Reserve, but currency and coins are minted by the Treasury Department's Bureau of Engraving and Printing. However, the Fed also determines how much currency and coins are to be minted. According to classical economics, optimal economic growth is achieved through full employment. Businesses and other organizations employ people to sell their goods and services, so if the people do not buy sufficiently, then economic growth declines, leading to unemployment, which creates more cycles of economic decline and more unemployment. So if the people do not spend enough, then the government can spend more to stimulate the economy. The Fed also reduces interest rates to encourage borrowing. Since people borrow to buy stuff, this leads to greater economic activity. The Fed monitors the economy, especially unemployment and inflation. The Fed uses monetary tools such as setting the interest rate to optimize the economy. A malfunctioning economy is poison to politicians, so the Fed was given some political independence so that it can maximize economic output rather than cater to the whims of politicians. Modern monetary theorists believe that controlling the money supply is a more potent tool for moderating the economy. They believe in increasing the money supply to pay for government benefits and promote employment, that interest rates are ineffective for moderating the economy, and that fiscal policy should be used more instead of relying too much on monetary policy. MMT also incorporates functional finance, stressing that the government should spend whatever is needed, regardless of the deficit. MMT is critical of conventional economics. They believe that setting interest rates is inadequate for regulating the economy. True enough, I would say, at least in some cases. Low interest rates did not help people during the Great Recession, because in spite of the low interest rates, banks did not think it prudent to lend to people with no jobs or to businesses with no business. MMT also asserts that the money supply can be increased without causing inflation, and that the government should intervene in other ways to mitigate inflation, such as by promoting competition in the marketplace. Another problem with using interest rates to moderate the economy is that it worsens business cycles. With lower interest rates, more money is borrowed, which leads to increased spending and higher employment, causing an economic boom. Then the borrowers must repay the loans, leading to less spending and higher unemployment, leading to an economic bust, causing more borrowers to default, depressing the economy even more. MMT asserts that deficits don't matter that much, but the interest on the federal debt is truly staggering. After all, $500 billion is not nothing. MMT argues that the money supply can be increased without causing inflation. This is true, sometimes. Increasing the money supply increases aggregate demand, which increases real gross domestic product, or GDP. If the economy is operating below potential output, as it is here, then increasing the money supply will not lead to inflation. Increased aggregate demand will simply use up some of the slack in the economy. Gross domestic product will also increase, as shown in the diagram, moving from AD1 to AD2. However, as economic output approaches potential output, increases in aggregate demand will start to increase prices, as you can see when the economy moves from AD3 to AD4. When economic output exceeds potential output, then increasing aggregate demand increases prices dramatically, while increases in GDP are minimal. Obviously, MMT has several problems. To start, politicians want to sell tax policy to their big donors, not set it in the interest of the people. It is the biggest thing they have to sell. Moreover, how money supply relates to inflation is uncertain and varies. So how changing the money supply will change inflation and how long it will take cannot be predicted. You probably already know this, but the government spends a lot of money. COVID-19 has increased this spending, but even before COVID-19, the government still spent a lot of money and will continue to do so. In 2020, the federal government spent $6.55 trillion, almost 92% more than the $3.42 trillion it collected in revenue. Total government spending equaled almost one-third of the total gross domestic product of the United States. It is clear that tax revenue cannot be replaced simply by creating more money. Pumping that much money into the economy every year would have devastating consequences. New money will either be spent or invested. Therefore, it will either lead to inflation as measured by the Consumer Price Index, or it will lead to higher asset prices. Higher asset prices will also increase other prices. For instance, higher housing prices will probably lead to higher rents. Over time, continually increasing the money supply faster than the economic growth rate will probably lead to both higher prices and greater inequality. Increasing the money supply is an easy political solution, since there is no statutory limit on the creation of money. Therefore, the money supply can easily be increased without congressional approval. However, this will lead to significant inflation for consumer goods and services and for assets. Therefore, tax revenue must continue to be the major source of funding for the government. The top 10% of American families own 76% of the wealth, and the top 1% receives 20% of the national income. Therefore, for any given amount of revenue the federal government receives, lower tax rates on the wealthy mean higher tax rates on the non-wealthy. Modern monetary theory is not the answer. Printing too much money has long-term, unpredictable consequences, and the deficit does matter, consuming more of the government budget as it increases. The only solution to this is to increase taxes on the wealthy. As the wealthy accumulate more and more of the economy's wealth, it will be more and more difficult to finance government without raising taxes on the wealthy. There is no way to avoid this. Otherwise, the federal debt will continually increase. Why is work the most highly taxed form of income? It takes the most time and effort, especially with ETFs. It takes little time to invest and virtually no time to receive benefits as a beneficiary of gratuitous transfers. Furthermore, people who only receive income from work usually need all their money just to survive, which is why they have few or no investments. Does it not make sense to lower taxes on work while raising taxes on investments and gratuitous transfers? The reason why non-work income is taxed less than working income is because that income accrues mostly to the wealthy who have influenced politicians with their money to keep their taxes low. This means that taxes on work must be higher to compensate for the shortfall. After all, setting lower tax rates on investment income and gratuitous transfers means that higher rates must be applied to income earned from work to receive the same tax revenue. Hence, the solution is simple. Increase taxes on all forms of income so that the tax rate is not less than the tax rate applied to work. This will be difficult politically, since most politicians are also relatively wealthy and thus benefit from their own tax laws. But this is the best way to fully fund government while also redistributing some of that wealth to lower income people. After all, much poverty is created by unfair laws, including a federal minimum wage law that has not changed since 2009. If all income were taxed like work, then the government would have plenty of money. No need for modern monetary theory. Thank you very much for your time. If you liked my video, please subscribe. I would appreciate any suggestions, so please leave them in the comments below. Also, check out my website at thismatter.com and my books at williamspalding.com. to continue your financial education. Thank you.